All right, so in this segment, we're going to take a look at Iron Condors and if they actually work, because there's always people who are skeptical about these kinds of things and these types of trades. So we're going to break it down, how they work, how do they make you money, and show you a couple of examples. So stay tuned. All right, so before we get started, if you really want to know a little bit more about Iron Condors, definitely check out the website at tradersfly.com. You can also take a look at the Getting Started page for options right there if you're brand new to trading options. And there's a lot of insight and information about trading options right there. Or you could check out the Iron Condors training in the courses section. Now, with that being said, let's take a look at Iron Condors, really how they work, how they function, and how they behave. We're going to go on paper first, and then we'll break it down on screen, and I'll show you some live examples as well. Okay, so an Iron Condor is basically selling a vertical what we're doing is selling a vertical put side over here. And if you don't know what a vertical is, we're basically selling one option over here, one put, and we're buying one under it. Okay, so this side, we're selling a vertical put. Okay, so it's sell. And then on this side, we're going to sell the call side. Okay, so this is also selling a vertical. So we sell one over here and then we buy one over here. So this could be selling one at the 300 strike and buying one at maybe like a 310 strike. So between these two verticals, I basically get this thing called an Iron Condor. And the way that it works and functions is this is the expiration curve, and this is what you'll mostly see in most softwares. You'll see the expiration, but there's also this other curve that's called a T+0 line. So this is a T+0 line, and that is the curve for today. And what this does is with time decay, as options decay, this gets closer and forms more into the expiration curve. So the way that Iron Condors work is that basically if you have a strike price over here at 200 and another one at 300 and your current stock price is at 250, as long as it stays kind of in this range, you can capitalize and make, let's say, your full investment with time, because options decay with time. So as this line continues to go further and closer to expiration, you're making money. You could get out of it early. That's no problem. However, if this price moves over here very quickly or to the downside very quickly, you're probably not making enough from one side or the other, and this could actually yield a little bit of a loss if you get out early. However, as long as you're inside these ranges, at expiration, you could net the full amount. So let me show you what this looks like on a trading screen. So if we go in on Boeing, and let's just say we're going in about 11 days out, and what I'll do is I'll sell the put side here, and this is, for those of you that know deltas, this is about a 20 delta for now. So I'm selling a 20 delta, buying the 12 delta. So I'm selling a 215, buying a 210. There's our vertical on this side. So I'll just put this one on for now as a ease of use example. You could combine these to do the Iron Condor in total, but this will allow me to play with it for you. And then we'll do the same thing on the other side, on the call side. So I will go in and let's say I sell something around a 237 and then buy a 242.5. And the current price is 226. So you can see we're kind of right here, kind of like in the middle. So when you look at these things, what happens is you've got a couple of things going on here. So I've got this line, that line is today, and this is the important line. This line over here is at expiration. Okay, so you'll notice I have to stay between these two lines. Otherwise, what happens is I get a max loss. Okay, and that max loss for me is right there. Okay, so I'm going to show you that in a second. So the most we can make on this trade is $129 at expiration. But today's line, you can see it's, it doesn't mean you're going to make that right away. That's at expiration. Now, on a per day basis, I make about $8 a day from the time decay. The current price, the delta, I don't want it to move too much one way or the other, so I kind of want it to stay stable. And volatility, or our Vega, is -5. So again, it's a little beyond the scope of this video, but I just wanted to show you that. Basically, we're risking about 371, okay, to be able to make 129. So risk of 371 to be able to make, okay, about a 130. So percentage-wise, it seemed pretty good, but you're not usually going to hold these things all the way till expiration. So what happens is if these things kind of stay stable for a couple of days, this line will slowly work its way, and I can do the adjustment here through the theoretical date. This is the Thinkorswim platform, and you can see 3 or 4 days into it, you know, you could be up $50 if the stock price stands still. Now, that's of course not realistic, but if it does move a little to the left, let's say over here, or a little to the right, you could still come out with, let's say, about $30 in profit, which is not too bad considering you're risking 370 to be able to make about 30. Okay, so still about 10% or so. So what you can do is get out early once you have a little bit of profit or you see the stock going against you. And this is how really Iron Condors work and how they make you money. And you're probably wondering, well, is this realistic? Is it really possible? Yeah, but on the technical side, most people don't trade them in this kind of way. See, Iron Condors are a little bit more dynamic. So once you start seeing a price kind of move a little more this way or a little more that way, what you'll see is you might get a loss. So that's why you start actually being more dynamic. You start changing and adding a little bit more to, let's say, the put side. So instead of doing kind of one contract here on a vertical and one over here on the call side, so here's our call and here's our put side. Instead of doing that, I might do 3 over here and only 1 over here. So you start getting these worked positions. Now, this is a simulated trade account, but I'll show you here is a live account on Caterpillar. Okay, so you could tell it's a live account right here. This is one contract I put on. Here's an example for you. And you can see this one's kind of been staying relatively stable. So a risk of $410 to potentially make 65 right now is the profit. And this is kind of a balanced, I've got one contract here and one contract here vertical on each side. This is the put side, this is the call side. Now I'll show you another example, what's more realistic. Okay, that one's kind of like a classic example, but here's one example on Moderna, also an Iron Condor, but notice this Iron Condor is a bit different. So what's happening is as this stock price kind of started going against me, again, a real account, and you can see right here, there's the live icon. You can also see it probably over here on the lower right, just the different platforms. One is kind of green, the other one is yellow. So this is the live account. And what you'll notice is that this one right here is also up about $65 on about $800 of capital. And what you'll see is that it's not a balanced one. So what I'm doing here is I'm selling some on this side. So I'm selling the put over here. But then what's happening is because this one's been going down on me or against me, the price is moving. What I have is I'm selling one vertical over here. Okay, then I have another one over here. So I've got 2 verticals at different points working on this trade on the call side just because the price been moving the other way. So I'll just show you that. So we've got one right here that's kind of only making about $4. Then we've got this other one right here that's at $28. And the most that I could make on this one, on this vertical is basically $21. So at expiration, it's actually, right now it's not calibrated properly, I guess, with the closing. It'll still yield $21 because I won't get filled on this kind of position because you'll see that white line is kind of above it. So sometimes you don't get that realistic looking price. So you'll see how this is a bit different, okay? And what you can do is slowly peel off one vertical here or there. Here's another one I'll show you for you, Microsoft. So you can see this one, I have a little bit more of a bullish position because here I've got a couple of extra puts. So I've got one put, and then one call. So I got the call side, I've got the put side, and another put side. So together, this kind of makes a different Iron Condor. I just want to show you that you don't have to trade big on these to be able to make a general return. What you can do is spread out, you know, an Iron Condor on, let's say, 50 different stocks. So you could have a stock, you know, these all over the place, and that helps diversify your risk. So rather than what some people do is they go, you know, they put this big one on and they trade like 50 contracts here and 50 contracts here all at one spot. Instead, what you could do is you could put on Iron Condors all over the place at different strikes at different points, and that's what you're seeing here. So that's a little bit more realistic, and I hope you get a better sense and understanding of what's going on here when it comes to trading Iron Condors, because the baseline and the basics, really, you're selling some put verticals, you're selling a call vertical. This is kind of a textbook looking version where you're basically balanced 1 and 1. But in the realistic world, as they start kind of moving, you're probably going to be a little more dynamic, making them be a little bit more unbalanced, whether that's a little more bullish, a little more bearish, just depending on your personal positions. Anyways, thanks for joining me in this video. Hope you stick around and check out some of the great freebies we have for downloads by clicking the link over here, or subscribe to the channel if you're brand new. Thanks again, and I will see you next time.